The Central Bank of Kenya has retained the base lending rate at 7.5% on the hopes that inflation will ease in the near term. Central Bank Governor Dr. Patrick Njoroge says the decision has also been hinged on indications that international commodity prices, particularly crude oil, wheat and edible oils, have begun to reduce. This is despite elevated global inflationary pressures, financial markets volatility amid the tightening of monetary policy in the advanced economies. In May, the Monetary Policy Committee raised the central bank base lending rate by 50 basis points to 7.50% in order to stem rising inflation and stabilize the shilling. This was the first hike by the policymakers in nearly 7 years. In June, Kenya's inflation hit a 58th-month high on soaring food prices, crossing the government's upper limit ceiling of 7.5% for the first time in nearly 5 years. A recent meeting by IMF officials appealed to the Central Bank of Kenya to consider tightening the base rate to avoid the spillover effects. The rising cost of basic commodities such as cooking oil, flour and cooking gas on the back of the war in Ukraine has squeezed most Kenyan households' budget. And during today's Monetary Policy Committee sitting, policymakers retained the base lending rate at 7.5% on expectations that inflation will start to reduce. CBK Governor Patrick Njoroge noted that global commodity prices for oil, wheat and edible oils have begun to moderate, adding that these developments are likely to ease domestic inflationary pressures in the near term. In June, overall inflation rose to 7.9% from 7.1% in May due to increases in food and fuel prices. Dr. Njoroge said that the measures employed by the government to stabilize fuel prices, lower electricity and subsidies on fertilizer prices, maize, cooking gas is easing the rate of inflation.